So the three investments investors should make in New York City real estate in 2026 under Mamdani are 421A tax abated buildings, small buildings in New York City, and raw land and development sites. These are going to be by far and away the best investments to make. So this is Roman Sinclair. I am at Sinclair Realty Group, the investment sales brokerage focused on selling properties in New York City, 1 to 20 million in value that sometimes get overlooked by larger brokerages. I also run the Roman Sinclair New York Multifamily newsletter, which studies the New York City multifamily market and kind of distills what's really going on, what the value traps are, where opportunities exist, and how investors should really be responding to different movements that are happening. I am going to talk today about some winners and losers in the current environment. A lot of this is driven by the Mamdani policy, but some of it has been the case for a little bit. And in that vein, we'll talk about the investments and the types of properties that make a lot of sense to purchase versus some that might get more hurt by the current regime's policy. So that's what we're going to look at today. To kick off the conversation, I want to just recap what's happened and what Mamdani's administration is considering. So there are two really important things that are worth paying attention to. Number one is the rent freeze that Mamdani has proposed. This has been a linchpin part of his campaign, and he's kind of hung his hat on the proposal. So it's something that I don't think investors should expect will go away. In my 2026 predictions, I do predict that it will fail to come to fruition. However, that's not guaranteed, and he's going to try very hard to make it pass. So investors should really pay attention to that. The second policy that is concerning to real estate investors in New York is the 9.5% property tax increase. This should be concerning and will have real impacts, and uh, and that's something that he's discussing with Hochul. So on the basis of those two policies, you know, where should investors, how should investors react? What types of properties make sense to invest into even more nowadays than maybe did before? And I want to frame this discussion truly around rent growth and revenue growth because that's the bedrock of a good business is top line growth. And in New York City, a lot of that top line growth is constrained by the regulatory framework. So investors who want greater returns want to focus on getting those assets that are um, that allow for that rent growth to happen. So three areas I think are worth looking at are 421A tax abated buildings, smaller properties in New York City, and land and development sites. So let's take each one of those at a time. With 421A tax abated properties, investors are essentially buying newer construction properties that were built sometime in the last 30 years for the most part, and they either have a tax abatement in place, which keeps the taxes very low, or the tax abatement has already expired, which means taxes are higher. Um, but with expired 421A buildings, the buildings are generally no longer rent stabilized under the 421A 15 program. So during 2010 to 2020, approximately 117,000 of these 421A buildings were delivered in New York City for 117,000 units, not buildings. So that's a pretty hefty number. lots of buildings, lots of opportunities there. And now that deregulating rent regulated properties is all but out the window, 421A properties offer investors almost the last way to purchase free market assets or properties that have a line to free market status at scale, right? It's the last way that investors in New York City real estate can purchase buildings that are free market or have a pathway to free market status at scale. Super important, cannot be overlooked. And if Mayor Mamdani passes a 9.5% property tax increase, 421A properties that are still under abatement are completely immune, and 421A properties whose abatements are soon expiring or have just expired, well, they get to benefit from the rent growth. That means Mamdani's rent freeze does not impact those properties. So it's kind of a good hedge. Those buildings that are in the 421A might see a few years of nominal rent freeze, but no property tax percentage increase. Those properties that have just expired from the 421A program, the tax abatement, they don't have to worry about any rent freeze because their units are now free market. So that's something that's really attractive to look at. What's also very important to mention is that these buildings, those that are built after 2009, are also going to be exempt from good cause eviction. So there are two forms of rent regulation in New York City: rent stabilized law, which has been in place has been in place for a long time, but it was sort of formalized in 1974, so over 50 years. And then good cause eviction, which is a newer regulation that came into effect in 2024. Essentially, the way to read the market is what's not covered by rent stabilized law is covered by good cause eviction. So that covers basically all of the housing market. The only exception is those assets that have certificate of occupancies after 2009. Those properties are exempt. And good cause eviction, as a refresher, functions in a similar way as rent stabilization, wherein owners of property cannot raise rents beyond a certain threshold. They must renew leases to tenants upon expiry. The only differences are those maximum rental increases are a bit more, they're a bit greater for good cause eviction, and there's a rent reset that happens when the tenant in place vacates. Tenant in place vacates in good cause, that rent goes with them, the new unit can be improved, the rent can be set at a rate that the market approves of between the owner and the tenant. Not so with rent stabilized law. So rent stabilized law covers about half the market, 45% of the housing stock. Good cause eviction more or less covers what rent stabilized law does not, save for that thin sliver of buildings delivered after 2009. So 421A buildings are exciting because they are that sliver of true fair market buildings that have neither rent stabilized law nor good cause eviction. So this is the good stuff. This is what should get investors excited. This is what you should be excited about if you're investing in New York. It's 421A buildings. On the flip side, there is also the opportunity to invest in smaller buildings. So smaller buildings that are under 11 units in New York benefit from having caps on their assessed value changes, which effectively limits how high their taxes can go. And since they're smaller than those of which that are fewer than 6 units are also statutorily exempt from rent stabilization laws. So really, we're thinking of buildings that are 1 to 5 units have sort of become very desirable again in recent years because they have quote unquote rent stabilized tax increases and free market rent growth. These are very desirous properties these days. If Mamdani passes a property tax increase, these buildings are almost immune because even if the property tax rate goes up, the assessed value will not change very much year to year. And that's just a very small percentage point being applied to the same base assessed value. On the flip side, if Mamdani decides to freeze rents, while these buildings that are 5 units and under are not rent regulated, Mamdani cannot freeze their rents. They're outside of that purview. So this is an important category that a lot of folks have begun investing into, especially in those neighborhoods and areas that are already very entrenched, considered very good areas with high rents and high median incomes. To be a bit more specific, these buildings we can think of this in three slices. Two of them are going to be tax class protected, and the third isn't, right? All within multifamily. So tax class one comprises 1 to 3 family properties or 2 apartments and 1 store properties as well. And their assessed value changes are capped at 6%, which is actually also 20% over 5 years, effectively making the assessed value CAGR only 4%. So if you think about it, the Rent Guidelines Board increase for a 1 year lease is currently 3%, either 3% or 3.5%. So that's really similar to the cap on assessed value increases for these smaller properties. It's very interesting, actually. But their revenues are not capped. Then you have tax class 2A buildings and 2B that are under 11 units. 2A buildings comprise 4 to 6 units, inclusive of 6, 2B 7 to 10, and their assessed value changes are capped at 8% or 30% over 5 years, effectively delivering a 6% year-over-year growth rate or CAGR. That's the really good stuff. That's makes a lot of sense to invest into. That's protected from some of these changes. What's not protected, those are the bigger multifamilies. Anything over 10 units has a tax class of 2. There is no cap on the assessed value change. The only caveat there is if there are big changes in market value in a property after a renovation, after a change of CO, well, the assessed value will be sort of how to say it'll sort of slowly be mixed in a transitional assessed value such that the ownership of the property doesn't suffer a big punch to the gut over the tax increases. They still happen, but they just are sort of worked in over a short period of time. So tax class 2 properties, i.e. most of the rent stabilized housing stock in New York City, no protection on tax increases, but a cap on those annual rent increases. Carlisle has been a pretty good sort of poster child for investing in these assets. A lot of other groups are doing them too. These smaller buildings, they're statutorily free market. There's no and there's caps on one of the biggest expenses, which is property taxes and assessed values. So very interesting for those. Those buildings, though, do have good cause eviction caps. Last thing I think is important to talk about is land and new development. And that also includes changing a building's certificate of occupancy and doing an alteration one, adding units. This is really important because this is the sort of most straightforward way to set rents at a level of market. Build a new property, you're the developer, you get to set the rents, they get to be at market. Fantastic. Second thing is, these buildings are also going to be exempt from good cause eviction. So once the rents are set, there is no ceiling on how much they can grow year over year, which allows investors to create value in the development, but also down the road, 10 years in, once the asset is cash flow stabilized, they can reposition a little bit. Folks can move out. They can get ample increases on rent as as time continues and goes on. And to sort of put this through the Mamdani screener, if Mamdani freezes rents, doesn't really matter for new development. If Mamdani raises taxes, it's a very nominal increase for a lot of these land sites, which aren't paying much in property taxes anyway. And tied into land too is just the conversation of supply and demand. So sort of as a sidebar here a little bit, if that rent freeze does go through that Mamdani is suggesting, that's going to drop the vacancy rate of New York City, which is currently at 1.4% per the 2023 New York City Housing Vacancy Survey. The 2026 survey is supposed to come out this year on that same study, so we'll get an updated figure. It comes out every 3 years. But right now, the latest data we have is that 1.4%. So if rents are frozen on those rent stabilized apartment units, a lot of tenants are going to be very happy about that because New York City is increasingly unaffordable for the average person. I think everybody knows this. However, if you lower the vacancy on half the housing stock, that means all the demand for housing has to be concentrated on the remainder of the housing stock, which is the good cause eviction or the free market housing stock, which is about the 55%, 50% remaining. That is going to make rents go up even more, right? Uh, that rent freeze drops the turnover on the rent stabilized units. It sinks the vacancy rate, which makes the remaining housing market even tighter. It means more longer lines competing for new rental apartments, and it just pushes all the fair market rents up even higher. I predicted in my 2026 predictions that median Manhattan rents would break median, not average, would break 5,000, and this year that median Brooklyn rents would break 4,000 this year, and both have happened already. I posted about it on LinkedIn. So that's just a commentary on the supply and demand that's going on. And so all three of these asset types, land, 421A existing buildings, and smaller statutorily free market assets, stand to benefit greatly, actually, if Mamdani's policies go through. So in a way, there are a lot of concerns around the mayor and his policies, and some investors are concerned, which I understand, but the mayor is also inadvertently sending signals that are going to translate to real gains in other parts of the market. It's these things can be modeled out, and sensitivities can be included to really show what doing something over here on the half the housing market that's rent stabilized is going to impact the free market housing segment. So that's kind of my view on the landscape. Of course, buttressing all this, you have three winners: land, smaller buildings, 421A assets, which are going to do really well because they're exempt from good cause. Underneath all this, you have the rent stabilized building class. The expenses are uncapped. The rent growth is capped every year, and so they're just holding up that housing market. And if those rents get frozen, then their revenue growth will flatline completely, and then their expenses will rise commensurate with whatever the market says. So those are some of the winners, and then that rent stabilized property is probably gonna take a bit more of a hit. Please reach out to me if you want to hear a little bit more about this. I can go into more depth. This is Roman Sinclair at Sinclair Realty Group. Please be in touch. Thank you very much. Bye bye.